Good evening. I don't know if I've got anybody joined just yet. We are set up, so we will be welcoming everyone in the next few minutes and getting going at about 6:30. Well, good evening, everyone. We are just around the 6:30 mark, so I would like to get started for this evening, and hopefully we may get a few more joiners as they get connected shortly. Welcome to our Shapcotts quarterly property focus webinar. I am Kimberly Shapcott, your host for this evening, and I am a qualified chartered accountant for my sins. I have over 15 years experience within the accountancy and tax sector, and in the last few years have also got involved in the property sector as a property investor personally. We've got several HMOs in operation, and we're also working on a couple of projects at the moment. So got quite a good hands-on knowledge of being involved in property from personal experience. This evening, I've collated some useful topics to keep you arguably up to date on the latest changes, a few reminders, and really things that people have been asking me in the recent months. And then we'll finish off with some questions. If you do have any questions, please do send them over to us. And we'll be clearing those towards the end, and we'll see how we get on. Alternatively, please do drop me an email or give me a call if there are more specific questions, and hopefully I can help with those as well. So first of all, what are we going to be covering this evening? So I've got a brief mention of our stamp duty land tax, just as a reminder of how it all fits together and potentially some planning opportunities if you are looking at buying mixed use properties. We've then got some tax return deadline reminders, followed by rental income and what you need to keep for your accounting records. Mention about VAT, because I do keep getting questions about how that correlates with rental income. And then finally moving on to a more, I suppose, technical point of moving your properties into a company and what you need to be considering when you're calculating that cost. Because I get asked quite regularly, is it worth transferring into a company? And the answer always is it depends. And it's really starting to look at what is the cost going to be of putting things into a company, and then what are you going to be saving in the long run. So tonight we're going to look at the cost of actually putting a property into a company to see what the implications are going to be if you're thinking about doing that. And then, as we've said, finish off with some questions. Normal risk warnings. Obviously, this evening, this is all very general. If you do want specific advice, you will need to obviously get in touch if you want to rely on anything. So stamp duty land tax, our first topic of the evening. How does it work? Well, as an investor, it is quite an important point to take account of the costs, as in recent years with the tax rule changes, it started to become quite a significant cost. So the key area that we want to be looking at for stamp duty is really finding ways to help reduce the impact of the cost. For residential investment properties, making the assumption you already have one property in your own name, whether it's bought in your own name or through a corporate structure, it will incur that high rate of stamp duty for any additional properties that are purchased. So that means you will start at the 3% rate up to 125,000, then you'll go up to the 5% rate up to 250,000, 7% up to the 925,000, 13% up to 1.5 million, and then 15% for anything over 1.5 million. Obviously, it's a stepped approach, so it's not just you pay 15% on the whole balance, which is how it used to be. These days, it has reduced slightly from where we used to be. However, this additional percentage has taken its hit for us all who are actively investing. Now, the key question I would say then is there any possibility that it's non-residential? For non-residential and mixed-use properties, the stamp duty starts at 0% for the first 150,000. It then goes up to 2%, up to 250,000, and 5% on the portions above. So as you can see, if you can get it as a mixed-use or non-residential property, it would be advantageous as from a stamp duty point of view, the costs are going to be significantly less. So if I just briefly go through things that are defined as non-residential property, this would include things like commercial property, shops or offices, holiday lets, agricultural land, forests, not that you can necessarily do an awful lot with those, any other land or property which is not used as a residence. And finally, 6 or more residential properties bought in a single transaction. So if you're potentially working with a retiring landlord who's got a reasonable sized portfolio and you're buying 6 or more properties, you may be able to purchase them as a non-residential transaction, which means rather than paying, say, 3% on each property, if they're, say, 100,000 a piece, you'd actually say the total I'm buying 600,000, and you'd be able to look at the non-residential rates, which could obviously noticeably bring down the cost of your stamp duty. A mixed-use property is one that has both residential and non-residential elements. So things like a flat connected to a shop or a doctor's surgery or office or something like that. So you've got multi-use in the building. Obviously, these are things to look out for, as you might think the cost isn't worth it, but if you're looking at your total cost of how much the project's going to be, this could help to reduce things quite noticeably depending on the size of the project. So let's have a move on now to tax return deadlines, which are fast approaching as we now are very close to Christmas. Now, the first question I would ask of anybody who is looking at tax returns is, do you need to be doing one? Now, obviously, if HM Revenue and Customs has actually issued you a letter to tell you that they want a tax return, you will need to do a tax return by the 31st of January. Whether you have someone helping you, whether you have an accountant doing it, it will need to get to them by the 31st of January. And if there's any tax payable, that will also need paying by the 31st of January. If anything goes in late, there unfortunately will be some sort of penalty. If they've not asked you to complete one, then they're not expecting one from you. However, that doesn't necessarily mean you shouldn't be doing one. We have a self-assessment system, which therefore means if you've got something to declare, you're the one that's responsible for telling them that you've got something to declare. So the key thing for this is if you have rental properties, if you've had them for a number of years, you'll have had to be doing a tax return for a number of years. So it's not really an issue if you bring a new one into the portfolio. You'll just need to make sure you add things in at the right time. If you've only recently started your property journey, then you need to ensure that you're going to declare any rental income on time. So for rental income, you need to declare it in the tax year that you start to receive the income. Therefore, if you started today this month in December 2018, then you wouldn't actually need to declare this income until your tax return for the year 2018 to 2019. And that tax return wouldn't be due until January 2020. So on that basis, you've got a bit of time, and you just need to make sure you tell them by the October deadline. So that would be October next year. If you started getting rental income before the 5th of April 2018, you need to be telling the taxman about it and paying any tax by the end of January. So let's have a quick look at 5 things that we just need to consider for your tax return. Just got 5 quick things for us to look at, as I don't want to get bogged down on tax returns, which is what I've been doing quite a bit of in the office recently. Firstly, all your income needs to be declared on a tax return. So that incorporates anything and everything you're doing. So this might include things like if you've got a job or benefits that you receive as part of your job, if you're self-employed, if you've got foreign income, rental income, your interest on your savings accounts, not your ISAs, but any normal savings account if you're getting anything from them, dividend income from your investments in the stock market or from your own company. And many people are setting up income property companies which collect their rental income. If you're taking any of that income out as a dividend, you need to declare that. Pensions and also taxable state benefits. You might have just one of them, you might have something in every category, but all of those need to be declared on your tax return. Having declared all your income, we need to just make sure that you're claiming all your tax reliefs. Let's try and reduce the tax bill as far as possible. So this is things like expenses in your employment. Are you claiming all your mileage or your professional subscriptions? As a qualified chartered accountant, I pay my annual subscription to my Institute of Chartered Accountants England and Wales. And this is something that as a professional subscription, I'm allowed to claim on my tax return because it's directly related to my profession. Have you got anything similar? Expenses for your self-employment in your accounts. So make sure you are claiming everything you can against your self-employed income, and as well as your self-employment, your rental business. Are you claiming all the expenses through your rental business that you've got in your own name? This might be repairs, maintenance, mileage to go visit the property, etc. Whatever you're spending, let's see what you can actually claim against the income. Pension contributions you have made. If you have made any personal pension contributions, these expand your basic rate tax band, which means you can earn more at the 20% tax rate. Gift aid donations are meant to be declared on your tax return. So are you including those that you have made during the tax year? Have you paid towards your student loan during the year? So if you are in a job and you've got rental income, have you made contributions to your student loan that you just need to make sure you put on your tax return? The reason for doing this is under self-assessment, the student loan will be repaid based on the income that you earn. So if you have a job and rental income, if your job's not generating enough income to make student loan repayments, your rental income might take you over that income threshold. So you might not just have some income tax to pay, you might also have some student loan repayments to make on your tax return. So if you are already making some contributions, make sure you put them on to make sure that it all gets taken account of, so you're not paying more than you need to. Are you claiming child benefit, but your income is over 50,000? If that's the case, it may need adjusting on your tax return. If it is also the case, you may want to have a look at what your household income is and how you are splitting it between you and a spouse if you're married, or how it all fits together, as you might be able to do a few things to make it more beneficial as a household and improve your income. And finally, as our fifth, is if you are married, not to push the getting married point this evening, if you are married, are you claiming the marriage allowance if it works for you and boosts your household income? The marriage allowance is quite a simple thing. It basically is that of a couple, one of you can pass your allowances to your spouse, whether it be male or female. You can pass up to 10% of your personal allowance. So your personal allowance this last year has been 11,500, which therefore means you can pass 1,150 over to them. This can be quite beneficial if you've got one person earning at the 40% tax band and one earning in the 20% tax band, because you can move the person who's the lower income passing to the higher income, which means the higher income person will have a bigger 20% band, so therefore saving 20% of tax. So it may be beneficial if you are not already taking it into account. So moving on to our next topic, which is a brief mention of rental income. And what accounting records should you be keeping for your rental properties? It's a question I get asked regularly. Now, at present, there are currently no specific legal requirements to keep things digitally. This is changing. At the moment, you don't have to do anything, but what is coming is you will at some point have to be submitting data to HM Revenue and Customs using a digital API. It's coming, it's not here yet. Now, what that will mean eventually is that you will have to use some sort of electronic software to record your transactions and then send them to the taxman on a regular basis. We work with a software supplier called QuickBooks Online, who we work with, and they sort out all the technical side of things for the software bits to make sure all this data submissions work smoothly. We're not expecting anything to be mandated in the next few years, but I will keep you in the loop as announcements are happening, as we are just getting the mandation. So we have to do it for VAT registered businesses that are over the threshold from April. We are probably predicting that this might come in for 2020 or moving towards 2021 or 2022. So we've probably got a couple of years before we have to be making any major changes, but it's just something to be aware of that is out there that we will need to be considering moving forward. At present, you can do what you want with your records. You can maintain them as you wish. Therefore, we see people just keeping paper invoices. We see people with manual books. People keep spreadsheets, or they do use some form of bookkeeping software. For use in the future, so it's things that you don't need now, but you will need when you sell your property. You will need to keep hold of all your completion statements, all your refurbishment invoices, all the different bits that you have spent on that property for when you sell it. You don't need that for your tax return until you sell the property and you are looking at capital gains tax. In terms of the day-to-day for your tax return, the records you'll need to be keeping are things like your rental statements, the costs for renting out your property, so things like tenancy agreement setups that letting agencies charge, and eviction or legal costs or visits or additional expenses. You'll need to keep your bank statements with your rental income coming in and out. I tend to recommend that people keep them separately. The reason you keep it in a separate bank account is it makes it easier for this sort of thing. And if the taxman does start asking questions, if it's a separate bank account, that is the only part of the information that they will be allowed to see. If you just have it in your general bank account, they will obviously see all the other transactions that are happening. So if they want to look at your rental income and your records, if it is separated, they won't be able to see your other personal bank accounts and your other transactions and what is happening. One of the other reasons for keeping things separate. You'll need mortgage statements, purchase invoices for all the things, named the few as you can see on screen, which is things like gas certificates, your insurance. Keep details of your mileage. We will be launching an app in the new year, which will have a mileage tracker, which you'll be free to use and hopefully help keep track of this going forward. Don't forget things like stationery receipts if you're getting paper for home. All of these different bits you can claim against your rental income, and we recommend you do to keep your tax liability down. If you have any voids, you'll obviously have things like council tax, water, electricity that you may have to cover. So again, all these expenses can be claimed. We tend to recommend people collate these in a book or on a spreadsheet, or it can just be the original invoices. It depends how you want to keep things together and who is going to be passed the information. So hopefully that gives you a good idea of some of the different bits to make sure that you are collating everything, you're claiming everything, because we want to obviously maximise your rental income but minimise your tax bills as far as possible. Right, moving on to our next topic, and then it will make sure we have plenty of time at the end to cover off moving properties into a company. VAT. Rental income is classified as exempt for VAT purposes, which means you can't register for VAT with just rental income. You can't really do anything from a VAT perspective. So therefore, if you've just got a rental company or things in your own name that are rental income, you won't need to worry about VAT, apart from you will have to pay it, unfortunately. If you're doing renovations, depending on the renovation, the refurbishment work, you may be able to claim the 5% VAT rate, or get, I shouldn't say claim because that confuses people. I should say you can ask your supplier, your builder, to charge you 5%. This is possible when you are changing the number of dwellings. And by dwellings, I mean if you have a family house, which you are then changing into, say, a 4-bed HMO, you would be able to ask any VAT registered contractor to charge you 5%. There's a few bits and pieces you need to do, but that's definitely one possibility. If you have a property that has been empty for more than 2 or 3 years, there are also some special rules there where you can claim lower VAT rates. So on that basis, for residential property and rental income, there isn't really many options of being VAT registered, and you wouldn't want to be because it's a lot of paperwork for nothing. However, for commercial property, this is different, as you have what is known the option to opt to tax a property, and this is done on an individual property basis. Now, when you opt to tax property, it means that you can reclaim the tax you pay on your property purchase. So things like if the property has VAT on, you can claim that back. Legal fees, any other searches you've had done, any other work you've had done, you'll be able to claim the VAT back. Then when the property is actually rented out to tenants, you'll then have to charge them their rent plus VAT. Now, for most VAT registered businesses, this is not an issue at all because it's just a cost and they'll claim it back on their next VAT return. The only problems arise with this scenario if your tenant type is actually not going to be a VAT registered business, as the cost will obviously be 20% higher than if they were renting somewhere that didn't have VAT on the rent. The option to tax lasts for 20 years and then it lapses. We've just in recent years got to the first 20-year point. So we've just seen the first option to taxes lapse in recent years. If you're entering into this type of transaction, I would say make sure you get the right advice at the right time to ensure that the paper is completed at the right times and the right stages. They can be quite interesting, they can be quite profitable and quite good opportunities. You just need to make sure you're doing what you need to do when you need to do it, so that you're taking full advantage of all the different opportunities. So now let me move on to my final topic of the evening, which is moving properties into a company. Now, there are a number of costs that need to be considered in relation to whether it's beneficial or not to move your properties held in your personal name into a corporate structure. And it's a question I have got quite a lot in recent months, in the last year or two, as we've had these changes and known that these changes were going to be coming in. There may be some reliefs available if you've lived in the property yourself, which would then give you the possibility of some private residence relief for that property, which would mean no tax on part of it. Now, income tax is calculated first, so any income you have in the tax year where you're moving something, and after your income tax is calculated, whatever your income may be, then capital gains tax is calculated on top of it. So within the basic rate tax band, we have 50,000 in the 2019-2020 tax year, which we're in, or which we'll be going into next year. And the capital gains tax is 18%. When your gains go over that 50,000, it goes to the 28% tax rate, which starts to get more considerably higher and more expensive. Let's have a look at something I put together so that we can just get a bit of an idea and work through how things fit together. So let's make it a little bigger and then we can look at moving things. Right. So what I kind of was putting together before the webinar this evening was something that just gave me a bit of a structure on how to show you to think about considering looking at whether it was worthwhile. So there's a couple of questions that I started off with. First of all, are you a higher or additional rate taxpayer? Now, a higher rate taxpayer is anyone over 50,000, and an additional rate taxpayer is anyone over 150,000 income. Tax rates being at the 40 and the 45% tax rate. So if you're in either of those, which in our example today, I'm just going to say yes, we are. And then what is our total income? So if we said our total income today is 50,000, which just takes us now into the higher rate tax bracket. There we go, hopefully you can see. So I'm just going to do number one on Derby Street because I'm in Derby and my brain is freezing. So if we say we've got a property on Derby Street, the purchase price we're going to kind of do was 100,000. And then we're going to say the current value has actually gone up to 200,000 because whoever we're talking about tonight, Mr. Blogs, he's held that for about 10-15 years. So the value's gone up quite noticeably. Now, his original legal fees, he probably can't remember, but if we just work on the basis, it would say £1,500. So we've got a bit of an idea of how things fit together. And when he did buy the property, he had about £10,000-15,000 worth of work on it because it was something that needed a few bits and pieces. So as you can hopefully start to see, the total gain there on this property is a whopping 83,500. So our capital gains tax, based on him being a higher rate taxpayer, is at the 28% rate of 23,380. Our legal fees on moving the property, I don't know what you're seeing at the moment. If we just did a round figure of 1,000, that would give us kind of a bit of an idea of what we would expect to see at the moment. So that's kind of the first thing that I would be saying to people to consider. What are the capital gains tax implications of moving your property over to a company? Now, what I'm going to do before I move on to the other costs that we need to consider, I'm just going to add a couple more properties. So let's just do 2 Derby Street, 3 Derby Street, and 4 Derby Street, just to give us a couple of different scenarios. So we're going to say number 2 we bought a little later, number 3 a little later than that, and this one we've only just bought at that. And we're going to just say all of them have a similar sort of value with where they are, and it gives us 20,000, which gives us a different gain. Now, if we say legal fees are going to be relatively similar for all of them, the newest one we only spent 2,500. A couple of the others we spent a little bit of money. And at this point, as you can gather, I am just throwing numbers in. When you come to look at these bits and pieces, you'll need to look at what the actual figures are for these projects or properties that you own. So let's just put something in there. So based on what you can see across, hopefully you can now see that we've got the latest one that is been purchased. We've only got a gain of 1,000, and when we put our legal fees in to move it, we're actually saying we've probably not really got any sort of gain on it. Some of the others we've got less of a gain. So if we just reduce that slightly because it's new property, we're not really saying that there's quite a bit on a couple of those properties to pay. Now, every individual does get an 11,000 allowance, so certain of those will go down slightly, but this is just really to give an inkling of how things fit together. Now, that's the first cost we need to consider. The second cost we need to be looking at, as well as our gains and what our legal fees for doing this work are, because that is obviously going to be actual cost to us today. The capital gains tax is going to be on our next tax return. Is that property mortgaged? Now, for our first one, we're going to say no. So arguably all the other bits don't really matter. For the other 3, we're going to say yes. Now, you might say, why does that matter? But if you've looked at your mortgages, if you've gone into a 2-year deal for a property, or you've been in a 5-year deal, as some people have in recent years with the interest rates being so low, have you actually got any early redemption charges? So if we said on all of these, there is early redemption charges, the question then is, what are they? So if I'm just going to throw 2, 3, 4,000 in for them because I haven't got any specific properties. But for you, it depends how far through your deal you are. What date can you actually get them at the reduced rate? Typically, early redemption charges tend to lower as things go through. So if you've got a 5-year deal, in year 5, you may be paying 5, 6, 7,000. In year 3, it might go down to 3 or 4,000, and in the final year, you might have 1,500. So there is a certain element of timings on this of when the early redemption charges kick in. So that's a second area that you need to consider when you're looking at the different costs associated with things. Now, if they are mortgaged, which we have said 3 of them are, do you actually now need to remortgage that property? Because if you've already got a mortgage, is it that you're going to put cash in and clear the mortgage on it, or is it that you now need to refinance it but through your company? Now, if you are refinancing a number of properties, you might be able to get a commercial valuation on all of them, and you might be able to get a portfolio lending product. If it's 1 or 2 properties, you might look at them individually. You really need to have a look at the broker to see what options they have. So in our scenario here, we had one fully paid for, so you probably say we're only looking at those bottom 3 properties that we want to be looking at refinancing because they already were refinancing. And if we are, there are going to be broker fees. Now, I'm finding that they tend to be £500 to £1,000 depending. So let's put in our broker fees. As well as your broker fees, you're going to be having product fees, which some of them can be incorporated into the loan and other ones can't be incorporated into the loan. So again, it depends what decision you're making on the different bits. If we work on, at the moment, just a round ball figure of, I'm going to put 1,500 in because they're some of the ones I've seen recently, it will give us an idea of what this cost will incur. Now, stamp duty. On the basis that we are moving properties into a company, we are in essence selling those properties to the company and there is stamp duty to pay. Now, on the basis we have got properties worth 200,000, based on what we were saying earlier, 200,000 times 125,000 times 3% plus 75,000 times 5%. So we're looking at 7,500 per property there. If they were all residential properties and you're selling them into your own company, I'm not 100% certain one way or the other at the moment if you'll be able to get a non-residential and not pay stamp duty. It would potentially depend how you are looking at selling the properties into the company. So you may be able to get some reliefs or you may be not able to get some reliefs. So that's just a cost that may or may not be there, but it's something to definitely consider as it could be an issue to have to work through. Now, they are all the key costs. So we've kind of covered the key elements there. So what I have at the bottom is put together a summary. So let me unfreeze the panes and go down to my summary. So for the 4 properties that we've had a look at up there, we're saying the capital gains tax payable is around 53,000. We're saying we've got legal fees to cover, we've got early redemption charges, we've got stamp duty, we've got the broker fees, the product fee. So we're potentially looking for those 4 properties with what I've thrown in of 102,900. So that's quite a significant figure. So the other side of things, which I've not prepared today, but would be the second step of this process, would be to start looking at the cost savings that you would be making by doing it into a company. So if you're paying 40% tax on all of your income, then you may be able to do some cost savings by having it in a company and not drawing that income until you want it. So there are a few things to consider there. So having done this side of things, we need to do the other side of things, which I can cover on a later session if it's something someone would be interested in hearing about, which then gives you an idea of whether it's worthwhile or not. Obviously, if you've got a portfolio of a couple of properties or 20 properties, you can see what the overall cost is for moving all of them. Or what we've found can be quite useful is if we go back up to the first few properties, as you can see, the last property that we purchased in the portfolio, we're actually saying there's probably not really any capital gains tax to pay. Now, it might be worthwhile to move that one into a company because if we look at all the costs moving across, we may have early redemption charges, but then it depends what date you transfer it over, that you might actually wait for a certain point and then transfer it. there'll potentially be refinance fees, and there may be stamp duty. But depending if the overall cost for that one is only about 10 to 12 to maybe, what are we? Let's use Excel to its finest skills. 14,500. If you can do it at the right time and you don't have any early redemption charges, you might actually be able to get it down closer to the 10,000, which is still a lot of money. But if you're planning to keep this property for the next 10, 15 years and you're paying a lot of expensive income tax, it may be worth spending the 10,000 now to be saving that over the next couple of years and over the next decade. So you may want to consider, this is all of the properties, but actually let's start targeting which properties are worthwhile putting into a company and which ones aren't. So hopefully what I've shown you today gives you an idea of how to start looking at it and how to calculate it. The second step is then to look at what the cost savings would be by having it in a company. And a further step would then be to see what is the best option, what is the best way of doing it, or which ones are better to leave in your own name, which ones are better to move into someone else's name, into the company name. Now, in talking about moving things into a company, there are other considerations to be making. So let me move back to our... If it is more tax efficient to move it into a company, a limited company in your own name, you can actually start to extend the shareholdings to reduce any future inheritance tax issues. So if you have children who are either getting involved in the business or they're not involved in the business, but you're planning on leaving your assets to them eventually, it may be that by moving them into the company, you can actually bring them in as shareholders, which reduces your estate and starts to move things down to the next generation and helps with that. What are your future plans for the portfolio? Are you keeping things? Are you expanding? Are you looking at selling? Now, if you're planning on keeping them for a while, it may be beneficial to go limited. If you're looking at expanding, if your income's already a higher rate income or an additional rate income at the 45%, buying through a company for your new ones could be a good option, even if it's not worthwhile moving your existing portfolio. If you're looking at selling and you're a higher rate taxpayer, it can be beneficial having things in a company, as in a company you will only pay the corporate tax rate, which is moving down to 17% on all capital gains. Whereas as an individual, you'll be paying potentially 18 or 28%. The one thing to be aware of is that at 18%, you will have your 11,000 tax-free section, which can make it so that you don't have a lot of tax. If you've lived in the property personally, you may not want to put it into a company because you'll lose that principal private residence allowance. So there is a few things to consider. If you do need any assistance in calculating the cost of moving properties into a corporate structure, we have a formal process, as you can see, to start helping you make an informed decision with our in-house tools. We're offering today and over the next 3 months, as part of our launch of this provision, the calculation at a price of $225 plus VAT, which will be going out in our newsletter, which will be going up to our normal price after our next webinar. As well as calculations, we are also going to be looking at providing advice on what the best method of doing and helping you work through that process. And again, if you are interested in any of this, please let us know by email or by phone, and we can obviously have a chat through this. And also it will be detailed in our newsletter that we'll be sending out next week as well. in terms of some of the bits we already offer, if you do need any help structuring things, operating bits, selling, inheritance, please feel free to get in touch with any bits. Now I'm approaching the end. We've not got much time for any questions, so I will just check if we've got any questions at all today. Any questions? So we've not had any questions so far today. I did get one question to just clarify something on the VAT side of things, which I don't think I quite covered, which was to do with the refurbishment side of things. In terms of what you need to do for if you are refurbishing a property to convert it from one dwelling to several dwellings, for my personal experience, we've done from 1 to 5 individuals sharing a property. What you need to do is complete a certificate, which can be found on the VAT notice 708. If you're not sure of that, let me know afterwards. And in terms of doing this certificate to tell your contractor, who will need to be VAT registered, if they're not, there's no point giving it to them, as they won't be charging you VAT in the first place. You give it to them, and then when they do their invoice, they will only charge you 5% VAT. The key thing to remember is you should only be charged 5%. It's not that they charge you 20% and you reclaim the 15%. Now, that looks to be all my time for this evening. So hopefully that was useful, that final clarification. The key takeaway I'd like you to have is that if you don't know or uncertain, ask the question, as tax can be a complex area, but when done correctly, it will definitely save you money. So you can spend it any way that you want to, rather than give it to the taxman. I'd like to wish you a happy and enjoyable Christmas and a brilliant new year. And I hope to speak to you in the new year, or we are open up until Christmas Eve if there are any questions, and then we'll be closed through to the 2nd of January, I think it is, when the office reopens. So if there is anything during that period, please feel free to send us a message or give us a call. No doubt I'll be looking at a few Facebook things here and there if there is any urgent bits and pieces. Look forward to seeing you in 2019 if I don't see you this next week.